Hey everyone, welcome to The Explainer. So if you've been in the market for a bit, you already know risk is just, well, part of the game. But today, we're moving past the absolute basics. We're going to fundamentally reframe how we view financial risk. We're taking it from this looming, scary threat and transforming it into a highly mathematical, manageable tool for building wealth. All right, let's just get right to it. Okay, let's dive into this. You know, the absolute most pervasive crap, and even seasoned investors fall into this, is conflating risk purely with permanent capital loss. It's this idea that investing is literally just a spin at the roulette wheel. And that leads to a very, very dangerous assumption. The idea that keeping your cash stuffed in a checking account equals 100% safety. Think of a safe cash account like a parked car. It feels incredibly safe, right? Because it's just sitting there, stationary. But over time, it is quietly rusting away out in the elements. Now, the stock market, that's the roller coaster. You are absolutely going to get whiplash, and yeah, your stomach will drop from time to time. But mathematically speaking, as long as you don't panic and jump out mid-loop, it reliably gets you to your destination safely. So, here's our logical roadmap for today. 1. Busting the risk myth. 2. The risk-reward scale. 3. The 4 types of risk. 4. Risk versus time. And 5. How to actually manage risk. All right, let's kick things off with Section 1. Busting the risk myth, redefining the enemy. So the crucial point here is that risk isn't just guaranteed loss. True risk is actually the uncertainty of outcomes. We're talking lower returns than you expected, sudden volatility, or just really poor timing. The enemy isn't risk itself, it's misunderstood risk. And honestly, avoiding it entirely is actually a massive hazard. 30%. Let that sink in. That is the silent, heavy toll of doing absolutely nothing. Because with an average 3% inflation rate over 10 years, you don't just break even by holding cash. No, you lose nearly a third of your real purchasing power. To put that into perspective, that safe money sitting under your mattress, it's basically being eaten alive by invisible moths. Moving right along to Section 2, the risk-reward scale, the core law of investing. And this brilliantly illustrates how risk and reward are, well, physically tethered together. Low risk, like your high-yield savings or bonds, yields low returns that barely scrape past inflation. Moderate risk, like broad index funds, brings some short-term volatility but historically builds actual wealth. And high risk? Think crypto or single stocks. Sure, it offers massive growth, but with a very real potential to go straight to zero. So anyone out there promising you guaranteed high returns with zero risk, they're fundamentally breaking the laws of financial physics. It's a mathematical impossibility. Okay, Section 3. 4 types of risk, demystifying the cloud of anxiety. Let's break this vague concept down into 4 clear categories. First up, we have market risk. That's the roller coaster of short-term economic volatility. Second is company risk, which is the danger of a single stock just completely failing. Think Enron or Blockbuster. Third, inflation risk. That's the silent rust we talked about, where your money just isn't growing fast enough. But the most important one, that's number 4. Emotional risk. Now, what's really interesting about this is that human behavior, our own behavior, causes far more financial ruin than actual market crashes. Panic selling during dips, chasing hype, buying peaks out of pure FOMO. It's wild. As the legendary investor Benjamin Graham once pointed out, an investor's absolute worst enemy is likely to be himself. Investing is psychology plus math, not just numbers. If you can conquer your own emotions, you've honestly solved the hardest part of the entire equation. Let's turn the page to Section 4, risk versus time, the ultimate cheat code. Listen, in the short term, the market is a highly unpredictable, honestly, dangerous place for money you need right away. A completely random geopolitical event could literally wipe out your housing down payment overnight. But if you zoom out, long-term investing changes the game entirely. Over decades, all that crazy volatility smooths out into a nice upward trend, and compounding works completely in your favor. Let's see how this builds mathematically. Over a single year, the stock market is highly risky. I mean, anything goes, high uncertainty. Stretch that out to 10 years, though, and the risk moderates as markets historically recover from the dips. But stretch it to 20 years, historically it becomes exponentially safer due to compounding growth. So counterintuitively, time doesn't compound your market risk. It actually absorbs it. All right, bringing it home with Section 5, how to manage risk, the antidotes. Before you even think about picking an asset, you have to balance these 2 profiles. Risk tolerance is purely emotional. It's essentially how well you sleep at night when the market is taking a nosedive. Risk capacity, on the other hand, is your cold, hard financial reality. It's exactly how much loss your budget, your age, and your timeline can actually afford. Two people could make the exact same investment, but it's only right if it completely satisfies both their tolerance and their capacity. Let's rapid fire these actionable antidotes. Step 1, diversify. Seriously, don't bet the whole farm on one trendy tech stock. Step 2, maintain a long-term focus. Step 3, invest consistently. This basically eliminates the timing risk because, spoiler alert, no one can perfectly time the market. And step 4, keep your strategy simple. Complex strategies usually just open the door for those really dangerous, expensive, emotional mistakes we talked about. So, this master framework really summarizes the whole shebang. If your timeline is extremely short, like under 2 years, your risk capacity is low. You got to stick to high-yield cash or short-term bonds to avoid that volatility risk. 2 to 5 years out, okay, you have moderate capacity. Use balanced funds or conservative ETFs so you don't derail those short-term life goals. But 5 years or even decades out, your capacity is high. Lean right into broad market index funds and stocks to defeat the inflation risk. Because remember, financial literacy isn't about completely eliminating risk. It's about choosing exactly which risks are actually worth taking. So as we wrap up this explainer, I'll leave you with this provocative question. Which timeline actually fits your life right now? Because I promise you, the second you align your investments with your real-world clock, you stop fearing risk and you start leveraging it. Thanks so much for joining me, and I'll catch you in the next explainer.